Hello everybody, I'm Herman van Papendorp, Head of Asset Allocation at Momentum Investments. As this is my first video interaction with you, I want to wish you and your families all the very best in health and happiness for 2026. As our main goal is to assist our clients with the successful pursuit of their financial dreams, let me guide you through our 2026 views on financial markets after a brief reflection back on markets in 2025. So what happened in 2025? Despite the heightened uncertainty induced by the second Trump presidency, 2025 turned out to be an exceptional year for South African investors due to rampant platinum group metals and gold prices, with broad-based strong absolute returns generated across asset classes, particularly among the local assets. Sharp rand appreciation on the back of rising gold and PGM prices and a weaker dollar helped SA assets to provide superior returns relative to global assets for local investors in 2025. Within the global asset space, equities outperformed fixed income in 2025, with emerging market equities outshining developed market equities, and Europe providing the best returns within DMs. Global cash was the worst returning asset class in the year, as interest rate cuts by central banks eroded returns. Although the strong showing by the SA resources sector was the predominant reason SA equities were the best performing main asset class in 2025, the SA financial and industrial sectors also played positive supporting roles, as the SA Reserve Bank cut interest rates and bond yields fell sharply. SA nominal bonds firmly outperformed inflation-linked bonds in 2025, but SA listed property provided even higher returns than the local fixed income asset classes in 2025, on the back of geared impact of lower local bond yields and accelerating earnings momentum. Cash was the clear lagging SA asset class in the year, as returns were eroded by local interest rate cuts. In a nutshell, our main views for 2026 can be summarized as follows. Firstly, we believe there is still room for South African assets to outperform their global counterparts, with relative fundamentals and valuations still in their favor. But after last year's massive excess returns from local assets, it would only be prudent to expect a smaller return differential in favor of SA assets this year. Secondly, within South African assets, our main preferences remain for SA equities, while cash is still our least preferred local asset class. Thirdly, among the global assets, we would rather be in global equities, and particularly emerging market equities, than global fixed income or global property, based on our expectation of how fundamentals will play out in the coming year. Let's spend a bit of time discussing the changing global geopolitical environment. The unpredictability of President Trump's policy pronouncements during his second administration has forced global financial markets to continually reevaluate the basic principles underlying investment thinking and portfolio positioning. What market participants have come to realize is that in the Trump era, nothing is sacrosanct or safe. Not policy, not institutions, and certainly not historical alliances. It is quite ironic, and probably an unintended consequence, that Trump's alienation of the rest of the world has caused the rest of the world to move closer together in a unified play on the adage that the enemy of my enemy is my friend. Whereas Trump's policy action in the initial part of his tenure have mainly focused on trade, immigration, and deregulation, his focus is now shifted to foreign policy measures, which are easier to direct through executive orders than economic policies that need support building in Congress. In this regard, the US military removal of the Venezuelan President Nicolas Maduro on the 3rd of January this year underscores the increasingly assertive posture of US foreign policy under the Trump administration, reflecting a strategic approach in which the US's superior military and economic capabilities are prioritized over adherence to established international legal frameworks. This again confirms that American foreign policy is now driven predominantly by US self-interest rather than the protection of democratic values around the world. At its core, the US will collaborate with any regime or undertake any policy or military actions if it suits American interests, regardless of international relationships and laws. The Venezuela incursion is consistent with the published December 2025 US National Security Strategy, which reaffirmed the long-standing objective of US strategic dominance in the Western Hemisphere, the so-called Monroe Doctrine, initiated in the 19th century to counter European sway in the region, which is now aimed at minimizing China's influence in the region by targeting China's closest allies in Latin America, namely Venezuela and Cuba. As part of this strategy, future military action in Cuba, Nicaragua, or Colombia cannot be ruled out. Neither can US actions against Mexican drug cartels. The strategy is also consistent with the US insistence that it needs to control Greenland. It is not inconceivable that President Trump may use the threat of military action as leverage in future trade, immigration, and drug discussions with Mexico and Canada. In essence, due to Venezuela's current small role in the global economy and oil market, the Venezuela intrusion is on its own not really that important for global financial markets in the near term. However, the broader implications of the heightened global uncertainty created by the current more aggressive US foreign policy framework provide a positive environment for gold and associated precious metals as potential alternatives to the traditional safe haven US assets of US Treasuries and the dollar, as part of a continual re-evaluation of the US as a reliable investment destination under the Trump administration. This could also provide support for non-US equity and bond markets should investors decide to diversify some future investment flows away from the US assets, but particularly in a weak dollar environment. Emerging markets, and ultimately also South African capital markets, should benefit in such a scenario. Let me now explain why we think fundamentals should continue to favor global equities over bonds. Reinforcing the anticipated rising risk from delayed tariff rates for US inflation going forward is the upward trend projected for inflation from leading price surveys on US manufacturing and services. In our view, the combination of anticipated rising US inflation, forthcoming fiscal stimulus measures, and a potential threat to US central bank independence from the Trump administration to force policy rates lower are all risks to the US bond market, while at the very least less negative for US equities than bonds, if not outright equities positive. Research by Morgan Stanley shows that the US equity market historically performed best when US policy rates were in a falling cycle, as is expected to continue in 2026, even though the magnitude of future Fed rate cuts is heavily debated. In addition, analysis by Citi illustrates that when US rate cuts took place during soft landing economic growth periods historically, global equity returns were particularly strong, pointing to potential further equity upside from current levels. While the regional profit growth outcomes were very dispersed for 2025, the consensus expectations for 2026 are much more synchronized and at a higher level than in 2025, providing more broad-based support for global equity markets. Although global bond yields have risen from historical lows since the pandemic, bond yields outside the US remain unattractive relative to their corresponding equity markets, with equity earnings yields multiple times higher than bond yields. While this relative valuation support for equities versus bonds is not evident in the US, the fundamentally more supportive environment for US equities than bonds discussed earlier could continue to override US valuation concerns for some time. In our view, there are both structural and cyclical factors that point to a weak US dollar environment remaining intact in 2026. Structurally, the volatility in current US policymaking, coupled with the disregard for previous alliances and agreements under the Trump administration, has led foreign investors to reassess the long-standing perception of the US as a secure and reliable investment destination, especially given the significant exposure many have to US assets. While a large-scale divestment of existing US holdings is unlikely in the near term, new investment flows may be less inclined to favor the US compared to previous years. Such a shift would have a negative impact on the US dollar, as would threats to the independence of the Fed. Additionally, some cyclical factors could work against the US dollar. These include a tariff-induced slowing of the US economy in the near term, which would narrow the positive growth gap with other developed markets, as well as anticipated Fed rate cuts exceeding those in other DMs. Together, these factors would suggest a weaker dollar environment moving forward. A weaker US dollar will likely have positive implications for EM equities relative to DM equities, as has been the case in the past. This is due to three key reasons. Firstly, a weaker dollar directly enhances EM equity returns in dollar terms. Secondly, EM commodity exporters stand to gain from higher dollar-denominated commodity prices. Thirdly, EM corporates and sovereigns with dollar-denominated debt will see a reduction in debt and debt repayments in local currency terms if the dollar weakens, improving their balance sheets and overall profitability. The relative EM equity outperformance of DM equities in 2025 has been lackluster compared to significant dollar weakness experienced last year, pointing to significant catch-up potential for EM equities going forward if dollar weakness is maintained. Apart from a weak dollar, there has also been broad-based earnings support for EM equities since last year, with earnings revisions for the overall region turning positive in 2025 and with most EM sectors now having positive profit momentum. EM has also become an attractive means to access the global artificial intelligence investment theme. Although EM AI PE valuations have caught up with those in DM, the growth rates expected from EM AI companies far exceed those from DM AI stocks. Fears about a near-term US growth slowdown have caused a tapering of US property income growth expectations, overriding support from lower bond yields. Delinquency rates in the commercial real estate sector have drifted up in 2025, while concerns are also mounting about a looming refinancing maturity wall at much higher rates, thus putting pressure on property valuations globally. Furthermore, vacancy rates remain high across most US-listed property subsectors. Although global property currently remains cheap relative to global equity, its valuations seem expensive relative to most fixed income assets, including nominal and real US Treasuries and global investment-grade bonds, with yield spreads well below historical averages. Turning to the local asset classes, we think there is still fundamental and valuation support for SA equities, and to a lesser extent nominal bonds. SA assets experienced positive support during the second half of 2025 from a move to a lower inflation target to 3% from 4.5% previously, the country's removal from the Financial Action Task Force's grey list, and a sovereign ratings upgrade from S&P Ratings Agency to a higher sub-investment grade notch while keeping a positive outlook in place. This makes us cautiously confident regarding the prospective trajectory of the South African economy and local asset class returns, provided that local policymakers continue to support rather than disrupt these improving conditions. Rand strength associated with these improvements and SA inflation consistently surprising to the downside in 2025 allowed the SARB to continue cutting interest rates, with further rate cuts likely in 2026. Falling local interest rates have historically been positive for both SA bond and equity returns, with equities normally the better performing asset class in rate cut cycles. The combination of lower inflation and interest rates has positive implications for the disposable incomes of consumers. With consumption the dominant demand side component of SA's GDP, this should extend the positive momentum in local economic growth into 2026, albeit from a low base. As a result, the earnings of SA companies with exposure to the local economy should be reinforced. At a time when the US tariff theme is prevalent in global financial markets, the SA equity market is very much protected from the negative impacts of higher tariffs on the country. This is because large SA listed companies have minimal direct revenue exposure to the US and are therefore unlikely to face any material direct top-line impact from US tariffs on SA imports. This stands in sharp contrast to major EM peers such as Taiwan and South Korea, whose listed corporates have significantly higher US revenue exposure and are thus more vulnerable to tighter US trade measures. This does not imply that SA-listed corporates will be entirely unaffected by higher tariffs. Certain companies could still experience indirect top-line pressure from the negative impact on domestic economic growth. However, it's important to note that less than half of the total revenue generated by SA's equity market is derived from the domestic economy. As such, the overall sensitivity of the SA equity market to local economic fluctuations and to indirect tariff effects is limited. Although the SA equity market has been one of the best performing global markets in 2025, this has been driven more by strong profit growth rather than a valuation re-rating. Indeed, SA earnings momentum has been the strongest within EM in 2025, accompanied by a relative EM D-rating, thus keeping SA's forward PE discount to EM close to pandemic lows. Based on our conservative 16% earnings growth assumption for the SA equity market over the next year, against the consensus estimate of 21%, we estimate that the SA equity market's forward PE is currently around its historical average. Although foreign investors seem to have bought into the improving fundamentals for the South African bond market, they've remained strong net sellers of SA equities in 2025. As such, they have not benefited from the strong relative returns of SA equities in EM and global portfolios last year. The combination of strong returns and net selling has caused the SA equity market to become even more under-owned within global EM funds, currently ranking as the third largest underweight position in these funds. SA's recent strong equity performance may help rekindle long-dormant foreign investor interest in SA equities. At the same time, an increased global allocation to EM equities driven by anticipated dollar weakness and increased diversification in response to policy uncertainty under the Trump administration could result in material global inflows supporting SA equities, particularly given that SA is a high beta play on EM equities. The almost 200 basis points rally by SA nominal bonds in 2025 on the back of positive surprises from actual local inflation numbers, the introduction of a 150 basis points lower inflation target, improving fiscal numbers, and a sovereign ratings upgrade has eroded the positive spread with global bonds. But although the SA nominal bond spread with the US has fallen to levels last seen in 2013, the real spread with the US is still above historical averages, as is the real ex-ante SA bond yield relative to its own past. This indicates that there is still some support for SA vanilla bonds from attractive real yields. Although the absolute level of SA inflation-linked bond yields is still high, the absence of inflationary pressures in the coming years points to a lack of fundamental support for ILBs, with no break-even widening expected in 2026 and monthly inflation accruals anticipated to be predominantly low and below average in the next year. The combination of moderately rising inflation in 2025 and 150 basis points of SARB rate cuts since September 2024 has pushed available real SA cash rates down towards its long-term average, making local cash an inferior investment alternative among the South African asset classes in our view. Fundamentals in the listed property space continue to improve. Companies are reporting the strongest like-for-like net operating income growth since 2018, with the earnings recovery guided to continue in 2026. The recent renewed sensitivity of property yields to SA bond yields also suggests investors have confidence in the sustainability of listed property earnings. Listed property funding conditions have also improved, with funding rates now the lowest in 3 years. Furthermore, the sector's balance sheet recovery remains intact, due to previous asset disposals and rising asset values. Vacancies are lowest in the industrial sector and highest in the office sector. So what are the potential risks to financial markets in 2026? With technology stocks such a large part of the US and thus global equity markets, concerns about whether tech companies will ultimately be able to monetize their huge past and future AI capital expenditure commitments represent a risk to markets. Should the AI theme deteriorate, the already high valuations of the technology stocks could be exposed, and the AI spending pillar of the US economy could come under pressure. Related to this, there will be a risk to markets should expectations about Fed rate cuts be disappointed in 2026, particularly with long-duration assets like AI-related equities so sensitive to discount rate assumptions. In contrast, should a less independent Fed cut rates more than fundamentally justified, equities will likely react positively to enhance growth prospects, while the bond market could come under pressure if the Fed's inflation-fighting credibility is questioned. The near-term negative risk to US growth and inflation due to the delayed impact from tariffs could still undermine US equity and bond markets in the early part of 2026. Although not our base case, should there be an adjustment in US growth expectations from the current soft landing scenario towards a recessionary outcome, this will put the profit outlook and equity markets at risk. Geopolitical uncertainty is likely to remain a reality for financial markets in 2026. Against the backdrop of an unpredictable and fluid US foreign policy, escalation in the Russia-Ukraine war, the Israel-Hamas conflict, China-Taiwan relations, US-China trade strains, North Korea's nuclear ambitions, and potential US military intervention in Latin America or Iran are all known risks that have the potential to destabilize global markets. Taking these potential risks into account, gold is expected to maintain its strategic importance in central bank and investment portfolios as a natural portfolio diversifier and risk mitigating asset. Since the outbreak of the Russia-Ukraine conflict in February 2022, gold purchases by EM central banks have been the primary catalyst behind the rise in the US dollar gold price. Elevated geopolitical risk and rising concerns over the security of US dollar assets in the global financial system, particularly following the financial sanctions that resulted in the freezing of Russia's dollar-denominated reserves, often described as the weaponization of the dollar, have materially contributed to this trend. More recently, increased uncertainty around US policy direction in the Trump era has further intensified EM central banks and global investors' apprehension about their concentrated exposure to dollar assets, reinforcing the shift towards gold as a strategic alternative. Unsurprisingly, gold exchange-traded funds inflows have risen sharply in 2025. Despite these developments, EM central banks still hold relatively low allocations to gold within their reserve portfolios. This indicates further potential upside for the gold price should major reserve holders such as Russia, China, India, and Turkey move towards the significantly higher gold reserve ratios common in DMs. Additionally, if US Treasuries were to see a deterioration in their safe haven status amid rising questions about the reliability of the US as an investment destination, gold would likely benefit directly. Such a shift would also further reduce the correlation between gold and treasuries, enhancing gold's role as a portfolio diversifier. On the local front, the paramount risk for SA financial markets would be a disintegration of the coalition government of national unity. In this regard, escalating political instability in the run-up to local government elections, anticipated to take place any time from late 2026, as national coalition partners campaign directly against one another on local platforms, could unsettle markets. In conclusion, we continue to favor South African assets over global assets for 2026. Our main overweights are in South African and emerging market equities, SA-listed property, and gold. This is counterbalanced by underweights in developed market equities, global property, global bonds and cash, and SA cash. With President Trump in the White House, we need to be prepared for some instability in markets at times in 2026. Expect the unexpected, But as long as we remain fixated on our long-term financial goals and do not make short-term rash decisions when these unstable periods arrive, we will be okay. A well-diversified portfolio remains the best defense against market uncertainty. Thanks very much for watching.